Kathleen, the Fed reaction to CPI is interesting because we know, being so data dependent, they're going to want to see a lot more evidence than just one print of softer price pressures.
Absolutely. And of course, remember, it's against the backdrop of that very strong jobs report we just had, of wages that are still pretty hot. So it's definitely reassuring to the Federal Reserve to see the latest numbers on the CPI. Far better that at least the headline came in weaker than expected, then came in much hotter than it did last month. And when you look at those numbers from 9.1 to 8.7, of course, that had a lot to do with gasoline prices. And gasoline prices go down, they go back up as well. So it's kind of a commodity story there. And then when you, I should say actually 8.5%. But when you look at the core CPI, you can see that it is at 5.9% for the second month in a row. It did not go up, but it did not go down. It is just staying where it was. And what you're looking at, I think, is so important there. Airfares dropping, that's really good. But shelter costs, they keep rising. Rents are rising. Implied mortgage payments, you translate the mortgage payment into rent, that continues to rise. That's something that's not going to slow down. So when people say, particularly in the markets, right, well, gosh, we got a little bit weaker number, maybe that would give the Fed a sort of mandate to think about easing. Well, it's pretty clear that far from thinking about easing, they're still pretty determined to keep on raising rates. Let's listen to Neel Kashkari, president of the Minneapolis Fed.
The idea that we are going to start cutting rates early next year when inflation is very likely going to be well in excess of our target, I just think it's not realistic. I think a much more likely scenario is we will raise rates to some point, and then we will sit there until we get convinced that inflation is well on its way back down to 2% before I would think about easing back on interest rates.
As many Fed officials have said, you can't just have a peak and a little bit of easing. You need months and months of sustainable declines. Charlie Evans, president of Chicago Fed, say inflation is unacceptably high. He sees the rate hikes continuing this year and into 2023. This is what the consensus has been for a while. It hasn't changed yet. Interesting, our Bloomberg economics team, looking at the core CPI, around 6% year over year, still pretty high, thinks it could head up towards 7%. There's just still enough in the pipeline in terms of wages, in terms of things like the rents, to keep them on the lookout for a higher number. Fed's certainly not going to ease off in the face of something like that.
Yeah, and you said it, you need months and months to be watching out for this eco data to change, but the Fed needs to make a decision in September as well. So what are they watching out for next?
Well, you know, it's like these two months, so you get two sets of the two most important numbers we look at now. You know, the employment report used to be the big one. It's still very big. And the Friday number was so strong. And that's where we saw wages continuing to move up. And then we also saw last week productivity falling. So unit labor costs were up more than 10% year over year. That's another source of pushing ahead in inflation. So when we get into September ahead of that meeting, we're going to be watching the next jobs report. Does it stay so hot? Charlie Evans saying that he sees a very strong labor market with good fundamentals. Another reason for the Fed just to say we've got to stay on this path. And then the next inflation report. This is a very important one. And in some sense, you could say today's report, not as big as that one, although today's report being a little bit weaker, a little bit softer, if we get another one next month. I think the most we can expect right now, you guys, is something like, well, instead of doing 75, they'll do 50 in September. And then maybe the next meeting, instead of doing 50, they'll do 25. They'll start easing back. But that's, I think, the most we can expect. And yes, you're right, data are going to depend it.